How do you know when to get out of the stock market? Wouldn't that be something that would be helpful if you could see it and say, oh, there it is. It's time to get out. I've called it in the past the canary in the coal mine. And at one point, I caught it. I saw it happening in the late 2019, the craziness of interest rates and debt that the country was taking on, and I got out. Now, I wasn't really accurate. I just happened to be in a very good position when the coronavirus came. Well, there was no way to spot that. But there is a way to spot it's time to get out of the market. And what I want to do is go back in history and show you that if you're observant and if you're really paying attention, you can see these things when they happen. So that's what this video is going to be about. I'm a long-term investor, so I don't get too hung up on corrections, on dips. I believe they will all correct themselves. What I think is important is to be in the right stocks at all time and not invest so much on the past and past performance of companies, but on what they're going to do in the future. And so I have to have a window into the future. And that's what we're going to talk about today.
Best of Us Investors presents Kerry Griegmeyer.
Okay, so let's look at a chart of the S&P 500 that takes us back to all the way back to what I think was one of the most evident signals that the market's going to crash, and that was the dot-com bubble. The dot-com bubble, I remember very distinctly from an event that I was in my backyard, and my neighbor, Brian, came over to the fence and talked to me about all the money he and his buddies were making in the stock market investing in these dot-coms. And I, at the time, was a financial advisor, and he was asking me, what do you think? And I said, well, I think it's irrational exuberance, if I knew that word at that time. And I think you need to be real careful. Oh, he says, we're making more money than we are as a doctor. Okay, that's a signal. That's a signal. And as it was, if you'll look on this chart, you'll see that bubble burst and the market crashed, and it stayed down for a substantial period of time and before it started to climb back up. So it was down from roughly shortly after 2000 to the beginning of about 2003, and then it started to climb, and it climbed, and then I think the next reaction or the next event was actually created by the banking system, and that was we saw people buying multiple homes and getting into the rental business who didn't belong in the rental business. And if you really want a good look and understanding of that, read the book The Big Short, or better yet, watch the movie. It's a really good movie. And you'll see how the banking system set up the stock market and the real estate market to crash because the banking system was corrupt. There's no other word for it. So when you see things that shouldn't be happening, as I said in the dot-com bubble, when secretaries were becoming millionaires because they were paid in stock, and then when the stock went public, they became millionaires. It isn't supposed to happen that way. As in the Big Short, when pole dancers were out buying multiple homes and renting them, it isn't supposed to be that way. That's a signal that things are coming to a bad conclusion. Then you have it's roughly in 2016, we had a small correction, and that was a result in drop in oil prices. Then in roughly 2017, 2018, or 2019, we saw a raise in interest rates, and we saw a short-term drop. And then the big one was the coronavirus. Well, there's no way to have spotted that. That blindsided us, and there's no way you should see that. And then we come to today. And that's the Robin Hood effect. That's what I have chose to call it. And it was a culmination of some events. Again, the coronavirus. You're going to hear me say many times, the most important thing that has happened in my lifetime relative to the stock market was the coronavirus. And this, again, was one of the unintended consequences. We were pushing money out of the Treasury, and people were getting money, and they were not working. So what did they do? They were seeing the recovery from the coronavirus, and they jumped into the stock market. And that brings me to this article in Friday's Wall Street Journal. On the front page, friends dreamed of fortune on Robinhood. These photographers joined in the online trading frenzy and embodied by their wins. And it created a false situation that then took stocks to unrealistic heights. We had then, along with that, just a ton of money coming in. I think in the year 2020, the federal government increased its debt by printing money and increasing the money supply by between 30 and 40%. And think about that. There were, call it 35% more dollar bills in the economy than there were in 2019. As a result of that money had to go somewhere. And so it got into the hands of these young people who had never traded before, and they saw their money growing. And then in Robinhood, if you had over $2,000, it was available for you to borrow against it. You were allowed to buy on margin. And that is to say, if you had $2,000 worth of equity in your account, you could buy up to $3,000 worth of stocks. In other words, borrowing another $1,000. Well, that all is swell as long as it is going up. But once that 50% ratio evaporates, you then get a margin call, and that requires you to sell your holdings and get out. And this article goes through the description of three young men who had met actually in January in Las Vegas. They were all school photographers. These are the guys that came in and took your fifth grade picture and your graduation picture in your cap and gown. Well, they weren't working. But they basically collectively got involved in the stock market with, no more than $2,000, $4,000 that then grew to $30,000, in one case to $80,000. And their common joke was, what color is your Lamborghini going to be? So this euphoria occurred within the market, and that when you see that and you say, that isn't supposed to happen. The people who know nothing about the stock market aren't supposed to be getting into the stock market and getting these kinds of raises in price. And then you saw the GameStop situation. That isn't supposed to happen. And Warren Buffett and Charlie said this back in 2019. When things happen that aren't supposed to happen, it's time to get out of the market. And if you'll remember back in 2019, Warren went to cash. He really, and that is exactly what we should have done when we saw this. Okay? So then it multiplied on itself as the government continued to put money out into the market. I saw then when the pandemic was, the vaccine came out and people started, and the market dropped, and these people got out, I saw the views drop on my YouTube channel. And I wondered, what's going on there? And as I read the article, these people, these young men, these young photographers, sat down and cried as to what they had done to their family, how they had taken their savings and basically blown it, and how they decided they didn't belong in the market. So that is what caused this short blip. As you can see on the chart, it's even hard to see because it's not that big of a drop. Now, yeah, if you were in some of the stocks that I'm in, because I believe in the future, and I have gotten aggressive about buying biotech, robotics, 3D printing, EV, and that's where a lot of this side bet was, and they so they dropped. I am confident that this is a temporary thing. I am confident, and I must admit, I didn't see it. I saw it, I recognized it, but I didn't have the courage to bail. I should have. In retrospect, I should have. And capital gains would have been no issue because I have strategically put most of my investments in IRAs. So there is no capital gain until I take it out through required minimum distributions. So I missed that one. But I share this with you because it's going to happen again. And you need to be aware of it. And put this phraseology in your words. If something is happening that shouldn't happen, get out. Okay? That's one of the new canaries in the gold mine. I'm not worried about this stock market. I believe, as Kathy Woods believes, that technology is coming so fast, and the need to correct situations, the number one of which being that we are, as a world, subjected to viruses that can shut our economies down and massively kill us, has to be cured. That has to be stopped. And that is going to be done through biotech. So I'm okay that my CRISPR is down, that my edits is down, that my INVATE is down, because I know this can never happen again, and it won't, because of technological disruption will come in and rescue the day. It will be bigger than the digital revolution. It will be bigger than the internet, because it not only makes our life easier, it makes our life longer. I don't know the number of how many people in the world have died as a result of this coronavirus that would not have died. 90% of them probably would not have died if it wasn't for that virus. So it can't happen again. So I'm comfortable. I'm ashamed that I didn't see, when I saw that nonsense with GameStop, that I didn't scream out, it's time to get out of the market because stupid is happening. And that's what you got to watch for. When the market gets stupid, it's time to get out. Okay, that's my lesson that I've learned that I care to share with you. If you like this kind of thinking, go to bestofusinvestors.com and give me your name and your email address and come to our Discord, and we'll have more in-depth discussions. I do every other Thursday. I do a live stream, and I talk in depth about what I'm thinking and where I think the market's going to go and where the future is. Understand, if you saw TV the other day, Goldman Sachs had a record quarter. That's what the professionals play for. They play for the quarter, January, February, March. Market skyrocketed. April, boom, went down. Why? To get you out, to get your money. So by next quarter, March, April, May, at the end of the May, they can get their $200,000 bonus again, or $2 million bonus again. You're playing against the professionals. Do not engage in a game with them. Play out into the future. They play quarterly. We play annually. Okay? Don't get involved in their day-to-day, month-to-month game. They'll beat you. You're not as good as them. Don't think, just like these 3 photographers thought they could win at the game. It ain't gonna happen. All right, talk to you tomorrow.